My friends, welcome back to another Dividend Happy Hour. Happy Friday. Hope you guys all had a fantastic week. And what a week it was. I mean, for those of us who were Starbucks shareholders, at least, it was a pretty good week. In fact, so much so that, at least over in my case, I'm looking at all-time highs in the account, guys. Let me show you real quick what's going on. So real quick, if we take a look at my dividend portfolio tracking spreadsheet here, which, as you know, this is totally free to use. You can download this spreadsheet. There's a link to it in the description of the video. But right now, guys, once again, portfolio is at all-time high. Right now, we're sitting at $76,603. I think maybe the last time I was talking about all-time highs, it was about 1,000 below this. So overall, really good week. And looking at the day gain here, it was a really good way to close out the week. But I hope you guys all had a good week as well. But with that, guys, once again, welcome back to another Dividend Happy Hour, episode 107. Before we do anything else, why don't we kick this off with a quick cheers? So, guys, grab whatever it is you're sipping on tonight. Okay, here's to you guys. Thank you so much for tuning in and hanging out with me for this next hour. I've been looking forward to this all day. I was really excited to do a stream tonight. But anyway, here's to you guys, and also here's to the dividends, the pursuit of that sweet, sweet cash flow, which is really what's bringing us together. And here's to financial freedom as well, all that good stuff. But cheers, guys. Cheers. Let me know a few things here in the live chat or in the comments below if you are watching the replay. Number one, I want to know, what did you buy this week? Which stocks did you pick up? So let me know that. Number two, I also want to know what you're sipping on tonight. What did you bring to drink to the Dividend Happy Hour? Personally speaking, I'm just got like this. It's just like a sparkling flavored water. It's one of those like Walmart flavored waters. Really good. Yeah, really tasty. It's just like blue raspberry, but nothing crazy tonight, guys. And also number three, I want to know, did anything cool happen in your guys' portfolio this week? Now, I would say the Starbucks jump in the all-time high is probably the highlight over in my neck of the woods. But what about you guys? I mean, did you guys hit all-time highs in your portfolios? Did you reach 100 shares of SCHD? Did you hit any certain dividend income milestones? Anything cool that happened to you guys? Share it here in the chat. We'll put it up on the screen and shout out some of your guys' accomplishments. So let me know those few things. I want to scroll up here and see who we got in the building tonight. So let's see, go all the way up. The first one that I see here is my man, Chris. Chris, what is going on? Hey, everyone. We got Shamir. We got Wing Addiction. Been MIA, but I'm back. Good to see you, my friend. I hope you're doing well. Adon's here. Mr. Mike from New York is here. JJ's here. El Dynamico. Great God. Mo Money in the building. We got Phil Doe the Great. Good to see you, man. Jan is here. John, Salvatore, Kevin from Orlando. Nice. Happy to see you guys. Smelly Fred is in the building too. Good morning. Good morning to you, my friend. Great God. Yeah. Salvatore already said what's up. Trista's here. One day closer to retirement. Couldn't have said it any better myself. Swampy Mears is traveling, but listening while I'm driving. Swampy, let us know. Well, do it safely. But yeah, let us know where you're headed. What's your travel itinerary looking like? I'm curious. Korean Cardboard's here. Good to see you. Rob Fresh. We got Jim, Andrew, Robert. This is a really good question. We're actually going to star this real quick. We'll circle back to this. Will's here. Prost. Well, that's like German cheers, right? Play 23. What's up, neighbor? Good to see you. Let's see. There we go. El Dynamico. As of today, our first milestone of the night, guys, I passed the $100 a month dividend payment. So, Antonio, is that just one payment that paid you over 100, or is this like throughout your entire portfolio for the month you crossed $100? And well, either way, congrats. But yeah, which one is it? Ooh, nice. Drinking Sapporo while dining in backyard to basically, it sounds like a home service hibachi. I love hibachi. That's like one of my favorite things. Hibachi. I love Brazilian steakhouse. Oh man, sounds so good. So good. Let's see. Yeah, Fast Eddie with Some interesting purchases, a little Sirius XM, Intel, and Energy Transfer. Got my first drip from Realty Income and Apple. Yeah, Intel's an interesting one. I mean, the word on the street is that Intel, and kind of the headline that's been going around for Intel, is that it's trading at its tangible book value, right? So yeah, I don't know. Intel could be a good deep value play, a good cigar butt stock. So we'll see what happens with it. It'll be interesting. Nothing would surprise me either, because there was one time Intel got down into the 20s and then it ended up shooting up into the 40s. So I don't know. I don't know. I see PLD. Yeah, I have a feeling we're going to see a little bit of this. So selling some Starbucks. I think there was probably a lot of profit taking this week, which is understandable. Why not? Some of you guys started your positions in the 70s when it was there. And so, yeah, I mean, why not? If you think there's better opportunities, why not lock in some gains? So I see some VU and SCHD. There we go. Yeah, this is a good point, Salvatore. This is the double-edged sword of dividend investing. I hate when a stock like Starbucks jumps. It sucks because now I need to wait to accumulate more. Well, hopefully, you got some good buying in while you had the chance, and hopefully now there's something else that you can jump to and focus your attention on. But it's tough. I was looking across my portfolio, and I actually, guys, I didn't buy anything this week. This was the first time in a while where I didn't add to anything. And I don't know, I was just looking across my portfolio and I was thinking, I could add to Visa. That's fine. It's in a fine spot to add to. It's still just a little bit below my average cost. I wouldn't mind continuing to add to it. But really my only other options that are around my average cost or below it would be like KRC, which I would add more to KRC, but I would wait to see, if KRC dipped under $30 per share, I feel like it would be, I'd have to add to it. So I'm kind of waiting for that to happen. WP Carry, I've considered adding a bit to, and I may end up doing so. Visa, basically my two biggest options right now are the two that I would be most likely to add to would be Visa or WP Carry. And I couldn't tell you the last time I added shares of WP Carry. It's been a long, long time. Johnson & Johnson's kind of near my average cost, so that could be a potential candidate as well. We'll see what happens, guys. But long story short, I just didn't feel like there was, I don't know. I just didn't feel like there was anything interesting I wanted to buy this week. Let's see. Shannon, really cool milestone. Congrats. $2,400 per year in dividends. That's, $200 a month. That's a huge milestone. So good job. That's incredible. There we go. Jana, cheers. Sipping on green tea and celebrating my first 2 dividend payouts this week. Congratulations. Yeah. And Jana, excuse me, let us know, how does, your first couple of payments, how does it feel? What do those first couple of payments feel like? Pretty exciting stuff. Yeah, there we go. Great God. New all-time high, getting closer to that 100K. Absolutely. Love to see it. AKKY sold Starbucks, now finally invested in J&J. There you go. Let's see. Kama said, sipping on some vodka. There you go. Didn't buy anything. It was a mistake. I thought more of a drop was coming. Well, maybe next week. Things have been so turbulent that it wouldn't surprise me. Nothing would surprise me. Let's see. Chris had a pretty nice shopping spree here. So Walmart, VU, SCHD, British American, Tobacco, Realty Income, and Visa. Nice. Very nice. Okay. Ooh, that sounds good. Ghost Cherry Limeade. Very nice. That sounds delicious. Okay. Salvatore added Comcast to the portfolio. Opportunity cost after getting sick of Walgreens. I get you. Let's see. What's up, Jack Murphy? Good to see you, man. Oh, this is cool. So Adon bought this. I mean, it's a random number, but an impressive number. Bought my 873rd share of SCHD, hoping to grab another 27 next week to, let me get a little closer to the mic, to officially hit 900 shares. That's crazy. Good job, Adon. I see Dividend Pros here. Ivan's here. Chuck is here. Good to see you guys. Let's see. I don't think I said what's up to Andrew. Good to see you, Andrew. J Jess? J Guess? I don't know. Happy to have you in the stream, my friend, though. Added more Chevron. Nice. Up to 100 shares of Chevron and picked up a little EPD. Good job. 100 shares of Chevron. That's nice. Let's see, Jim. Big buys this week were Walmart and Deere before earnings. Deere had pretty good earnings from what I remember, didn't they? Didn't they beat on their earnings pretty nicely? Let's see. Yeah, they certainly did. They're up. If we jump back over the screen, they're up almost 9% for the week. So that's great. How was Walmart's? Because I know Walmart reported earnings as well, and I thought I saw they put up some pretty good numbers too. Okay, well, Walmart doesn't expect a recession. Okay. Yeah, I remember. So funny. This must have been what it was. So there was one day earlier this week I was talking about, I think it was the day that Starbucks had their big news. I was talking to my wife about it, and she has Target in her Robinhood account. And she said that it was up like 6% for the day. I think it was that same day. Maybe it was the day after or something. But anyway, Walmart pushed higher in early trading Thursday. So this would have been yesterday. So maybe it was yesterday. I don't remember. Comp sales were up. Okay. What are like okay. Q3 sales growing. Okay. Yeah. So Walmart is firing on all cylinders. No surprise. I got to tell you guys, I've said this before, but my wife and I do all of our grocery shopping really at Walmart and Sam's Club. We have a Walmart right behind where we live, and a Sam's Club like right down the road. And I'm extremely impressed with the Walmart here. I don't know what it is, but it is like multiple levels nicer than the Walmarts that we had back in Northern California. Not only in my hometown where my parents live, but like also my wife's hometown where her parents live. The Walmarts there just like are not nearly as nice as the one that we go to here in Vegas. Same with the Sam's Club. Just very impressed. Let's see. There we go, Chuck. This is cool. Bought few ETFs, all of those right there, and also crossed $1,000 invested. Good job, my friend. Good job. Gilly says, not buying much this week. Bought ARE, which I think is Alexandria Real Estate. Last week, building my cash reserves in Schwab to buy more in the next few weeks. Nice. Good stuff. We'll probably sell Starbucks to lock in gains. There you go. Sir Dudebro, man, good to see you. Wow. Okay. Nice bias from Jana here. So 5 VTI, 7 VEU, 10 Altria, 10 SCHD. Good stuff. Frank from South Dakota. Good to see you. Okay. Let me just get caught up here. I'm about 7 minutes behind in the chat. I'm going to scroll down a bit here. Oh, this is an interesting question. So, Ryan, I've been watching your live since episode 100, and I went back and started watching from the beginning. So I wanted to ask, why did you decide not to invest in Simon Property Group? I don't really know. I mean, I honestly don't remember if I was ever really seriously considering Simon Property Group. Maybe like early on in my investment journey, I was looking at Simon Property Group, but I wonder, I really don't know. I don't have a good answer for you because it's been so long, but yeah, I just don't have a good answer for you. I really don't remember, but I do like Simon Property Group. I think it's been kind of surprising. Like I'm surprised to see that it's up so much and held up so well. Yeah, these dividend stats are interesting. I haven't looked at this company for a while. So they obviously reduced their dividend back in 2020. And it's not yet recovered from its highs prior. It's almost there. It's basically there prior to the cut. You know, that could have potentially been a reason. Once again, I really don't remember because it's been so long, but that could have been a reason. I could have just not liked that they cut their dividend, and albeit it was during a time where I think they get a pass for that. Yeah, I don't know, but even looking at this now, I look at this and I think, it's okay. This is fine. I think they'll be fine. And I will tell you what, too, the Simon Property Group properties that we have here in Vegas are top notch. The Forum shops at Caesar's Palace, super nice. The Crystal shops at the Aria, super duper nice. And they have some outlets here as well that are also very nice. So I have really liked every Simon Property Group location that I've been to in Vegas and outside of Vegas. But I don't know. Maybe I don't know. What did I reinvest into instead? The FFO looks pretty good. I will say that. Aside from 2020, this is going up pretty steadily. So yeah, I don't know. I think there's some stuff to like about SPG, but I'm definitely I'm definitely fine with my with my batch of REITs right now. I've got 4 different REITs, and so I definitely, yes, SPG at this point is just not on the radar. It's a fine company though. So this is a good question. JJ says, are you planning on selling off some Starbucks and redistributing it back among the portfolio? At this point, I'm not. I'm just holding on to Starbucks. I'm just holding. Don't plan on adding any more. With the jump, guys, it's far and away become the largest position in my portfolio. And I did share this in the video that I put out on Starbucks earlier this week. I did show this. So let's do this. So Starbucks is now almost 11.5% of the total weighting. And this is what the returns are looking like. So when you're 10% share price return, about a 13.3% total return. So that's good. I'm not in a rush to sell any shares. I feel good about Starbucks, looking, and obviously anything could happen. And I could totally end up being wrong about this, but as of now, I feel good about Starbucks, 5 years down the road, 10 years down the road. So, yeah, so I'm just planning on holding on to it for now. We got my man Matt in the building. A Smirnoff Red, White, and Berry Ice. Nice. And this is cool too. 50th share of SCHD. Good job, man. Great job. And thanks for tuning into the stream. I'm happy to see you here. So SJ says, this is a good question. At what price should someone start buying Johnson & Johnson? That's a good question. Personally speaking, I would be looking to add, I could add a bit more to it now because it's below it's actually just above my cost basis. I'm like break even with J&J looking at the share price returns. So that's fine. But I as far as starting a new position, you could do it now and you'd be totally fine. I think, but I think it's much more enticing and much more appetizing. It may be around $145 per share. And it's been there in the last 12 months. Their 52-week low is about 143. So I think about 145 is a pretty nice around there. 145, basically sub 150, I think is a good, this is me personally, under 150 is a pretty good thing to look for a price to look for J&J, in my opinion. So this is a good question too. Where are your thoughts on Cintas and the stock split next month? So I just recently added Cintas to my watch list, and truth be told, I haven't spent any time. CTAS, got the ticker wrong. I haven't spent hardly any time with it since I added it to the list. And I didn't even know that they were going to be doing a stock split. But okay, so they announced it a few months ago, a 4-for-1 stock split. I think this is a really great looking company. And I don't have any thoughts about the stock split, but I think this is a really, really solid company. Seems like it's a really great dividend growth stock. Obviously, the yield's a bit on the lower side, but yeah, that dividend growth rate's really sweet. 38 years of consecutive dividend payments. I think there's a lot to like about this company. The financials look great as well. So I'm excited to dive a bit deeper into Cintas, but yeah, things have just been busy. I haven't been able to do it. I've been trying to keep up on all the quarterly earnings of the stocks that I own and stuff like that. So, but yeah, overall, I think it's a pretty solid company. Oh, Mike, there you go. Hit 100K in the account this week. Congrats. Like, that's awesome. 6 figures. Officially across the 6-figure mark. Good job, Mike. Let's see. This is cool too. Casey just got to average of $20 a month. Okay. So, 240 per year in annual dividends. Not much, but it's a start. Casey, that's incredible. $20. Pretty soon that 20 will be 50. That 50 will be 100. That 100 will be 200. So it happens faster than you think. Just stay with it. Keep at it. You're on the right path. So good job. Phil, no buys this week, but my portfolio almost hit 80K. Phil, my friend, you and I are neck and neck. I mean, you're probably a couple thousand above me right now, but we're pretty close. We are pretty dang close. Good job. Anyway, let's keep going here. Sorry guys, I'm about 10 minutes behind in the 10 minutes behind in the chat, so I'm going to get caught up a little bit. I apologize if I skip over some of these, but I want to see. I want to get caught up. I don't want to get too behind. Okay, I think it's about time we get to this too. So DGI Crab went off on how much I can't stand YieldMax the other day. May have name dropped you, Ryan, in a positive way, of course. Well, thanks. Hope you all are avoiding the scam company like the plague. So this goes back to, this is a callback to what Robert was asking at the start of the stream. Why not just buy YieldMax ETFs? And I'm probably beating a dead horse with this conversation because it gets brought up pretty much, not every stream, but more often than not, YieldMax gets brought up. And I'm just not a fan of these funds. I think that they're yield traps. I mean, I think it's pretty easy. On one hand, I think it's very easy to be tempted by a dividend yield like this. But over time, dividend safety, over time, the dividend payments have gone down. So, and covered call ETFs all pay variable dividends. So they do fluctuate in some capacity, but as time goes on, the situation for TSLY just keeps getting worse and worse. And I'm using TSLY as kind of like a blanket example for all the YieldMax funds. Some of them have done pretty well so far being the operative, like the key phrase. I think NVDY has done okay. I think Coney has done okay. I'll double check that, but I'm using TSLY as a proxy for the rest of the YieldMax funds. I just don't, I think I don't think any investors question these funds beyond just looking at this and being like, oh, I can make my money back in like a year and a couple months with a dividend yield like that. But it's not the full story, because over time, your payments are getting lower and lower and lower and lower. And so over time, the dividend income that you're receiving for the shares that you own is going down. And therefore, your yield on cost is going down, when over time, it should be doing the opposite. Over time, you want to invest in stocks whose dividend histories, instead of looking like this, look more like this. And you will never find that with the YieldMax funds over a long period of time. It's just not something you'll get. And in the meantime, you're being charged a 1% expense ratio, which is a super high expense ratio for ETFs, and you're getting poor performance as well. So this is just the share price return. Okay, if you would have bought TSLY a year ago, your shares would be down 51%, as opposed to the S&P, which is up 26%. And you know what? To be fair, let's not compare it to the S&P. Let's compare it to maybe something more in this ballpark, like JEPI and JEPQ, which I'm personally not a covered call ETF guy. I stay away from them. But I do think these two right here, JEPI and JEPQ, are some of the more premier covered call ETF. So I do think this is a fair comparison. Once again, this is just the share price. So let's look at the total return, which includes dividends. So on this note, it's not good. You're still losing, even with all those dividends, you're still losing 11.6% investing in TSLY. Okay, sure, you're getting a quote unquote 83% yield, which actually, let me pull something up here. YieldMax. There's something and I don't remember the specifics of this off the top of my head, but there's the difference between these two. But there's a difference between the distribution rate. This would be what Seeking Alpha would show as the dividend yield. There's a difference between this and the SEC yield. And let me see. I thought there was a disclaimer on here that showed that. So SEC yield, I thought there was something on here that went into that, but it's an important distinction to make. Okay. And I don't remember what the difference is. Let me see if I can find it. So difference between distribution yield and SEC yield. Okay. So, okay. Here it is. The SEC yield is an annualized figure based on returns over the most recent 30-day period. As outlined above, the distribution yield takes the most recent distribution, multiplies it by 12 to get an annualized total, and then divides the result by the net asset value. So, I'm trying to think about what the difference is, like why there's such a big spread between these. It has to do with the net asset value in some way, shape, or form. But I also think that's why that I could be wrong on this, but I think that's maybe why TSLY, part of why they did a reverse split. And I could have this wrong once again, but they did a reverse split where instead of basically if a 2-for-1 normal split would take, if you had a $20 share pre-split, it would be $10 and you'd have 2 shares. Well, the opposite happened with TSOY, to where if you had 10 shares of TSOY before the reverse split at $10 per share, afterwards you only had 5 shares at $20 per share. So yeah, I don't know. I don't remember the exact specifics, but long story short, there's just a lot of bad, and there's a lot of complicated aspects to these funds that make me personally want to stay away from them. And I mean, as we saw, based on the performance, it's not good as well. It's not good either. So even just based on that, I don't see why you'd want to invest in this. You're paying a 1% expense ratio to essentially lose money. So, and that just doesn't make sense to me. So. Let's see. Bear with me one sec, guys. And I know I didn't do that explanation justice. So, but on my channel, I have a couple videos on TSLY. Like if you just go to my channel and just search TSLY and then my name on YouTube, you'll see the couple of videos I posted. I give some more detail on the difference between the SEC yield and the distribution yield. I believe I do in those videos. But anyway, if you want a better, more coherent breakdown, check that out. So, okay, but moving on. Trista, have you purchased any Rollins yet? No, unfortunately, I have not. Rollins is sitting at about $49 per share. It's still a bit too rich for my liking. I am being patient with it. And if at this point, if I see Rollins get somewhere in the low 40s, then I'll probably start a position and start averaging into it from there. But yeah, I'm staying patient with it for now. A couple of questions about Seeking Alpha here. One, in terms of research, do I mainly use it? And Janice, is Seeking Alpha Premium worth it? So starting with this question here, I think Seeking Alpha Premium has been very worth it. I've used Seeking Alpha Premium for the last few years now. Pretty much since I got into investing, I've been using Seeking Alpha from the jump, and it's been fantastic. It's been a really great platform, and I don't have anything bad to say about it. And I will say probably the biggest benefit that I get to using Seeking Alpha, the thing that I think makes it most worth it, is having access to the analysis and the news. I think that's been the most helpful feature. And with the news here too, you get access to the 10Qs, you get to listen to the quarterly earnings calls, and it's just a really good all-in-one platform. And it's very in-depth too, a lot of data. So yeah, I've been very happy using Seeking Alpha. and I would recommend it. And you can try it out for yourself. They give you a 7-day free trial. If you use the link in the description, you can try it out for free for 7 days. And I think it's at least worth it, trying it firsthand to see if you like it. But then in terms of the second question, so do I mainly use Seeking Alpha? Yeah, I would say that up until this point, I've mainly used Seeking Alpha, and I've shown you guys this before in some videos, but this is actually a new stock analysis software that I've been working on the last couple of months now. It's been a little secret project, and it's called Snapstock. I officially finished the logo. I mean, not anything crazy, but finished the logo for it and branding for it this week, which is cool. Cool to see it up here. But yeah, this is a new stock analysis tool that I've been working on, and I find I'm biased because I've been building it, but I've found myself, like, when it comes to looking at financials, since I started putting this together, and since it's still very much a work in progress, but since it started coming together, I've found myself just naturally wanting to use this more and more, which once again, I do have a bias in saying that, but it's true. Like, even if this wasn't my platform, I would still say the same thing. It's just been a very simple and straightforward way to look at a lot of the need to know data around these stocks that you're looking to analyze. It's just a really good quick hand way to get some in-depth stock research. You can see the share price, you can see the valuation, you can see the dividend stats, the growth metrics, the important ones: revenue, earnings per share, free cash flow per share, profitability, how are the margins looking? You can see the debt situation, return on invested capital, and you can see how everything's trending. It's clearly all laid out very clean. And this isn't out yet. Like I said, this is a work in progress. I'm hoping to have this out in the next month or the next couple of months. But yeah, I'm really psyched about this. This has been not only a really fun project, but it's also so far been a very, very helpful platform. And we can test it out. We can try it out. So if you guys have any stocks you want to look up, we can plug it into Snapstock here and see what, just see it in action. But the caveat to this is, because it is still so early stages, you can really only look up like normal companies. And by normal companies, I mean like your Visas, your Microsoft, Apple, Procter and Gamble. It doesn't have any of the REIT specific metrics yet. And that's going to be coming in a future version. So it is a bit limited in the stocks that you can look up. Like, I could look up Realty Income, once it loads. I could look up Realty Income. I could look up any other REITs or whatever, but it's just not going to have like your FFO. It's not going to have some of those things. So your P to FFO, the REIT specific metrics. So that'll come in time though. But yeah. Oh, and also with Snapstock here. So if you guys want more info on this and want to stay in the loop and get more details, if you go to retirewithryan.com/waitlist, it will take you to this page. Put in your email, and then when the time comes, I'll send out more information on Snapstock's release. And there's also some other stuff that I will be releasing at the same time. The Investor's Almanac, which I've talked about before. Some other stuff as well. But if you want more information, just go to this page, retirewithryan.com/waitlist. I will link it in the pinned comment after the stream ends. But just put in your email here, and I'll be sure to send out some information whenever there is more on the release and updates. So I should be doing that here pretty soon. Let's see. Cami here says, and if you guys have any questions on Snapstock or Investor's Almanac or anything too, let me know. I'd love to show you more. So Cami says, I'm not selling Starbucks. This is the turnaround. Here's the thing. I don't even know if this is a turnaround, really. Like, they've had a couple rough quarters. They're not the only ones. Plenty of other restaurant companies have as well. McDonald's for sure. So I think Starbucks is still in a fine position. Like, their same store sales were down. Like I said, they've had a couple of rough quarters, but I do think that's to be expected if the consumer in mass is tightening their wallets and is a bit more defensive in their spending. I just think it's natural to see this. And yeah, I don't think the situation with Starbucks is or was as dire as it has been made out to be. That's my personal take. Interestingly enough, and I know same store sales are down here at home, internationally, China, they were down 14% in the last quarter. I get those bad metrics, but if you look at some of the higher level numbers, if you go look at Starbucks' 10Q for the 3 quarters so far in 2024, revenue's actually up for the year compared to last year. I think earnings is the net income is like right in line with where it was last year. So long story short, I just don't think the situation's, and I actually think free cash flow is up, or at least their operating cash flow is up year over year for the first 3 quarters. So anyway, long story short, I just don't think the situation's as bad as it's been made out to be. I still feel totally fine owning Starbucks. A lot of people like to bring up maybe their debt load or something like that, taking on a lot of debt. But if you look at, I'm about to go on a tangent here too, so I apologize. If you look at how their debt is spread out, like all of their debt is pretty much long term, and they have notes going out to 2050. And I think on average, like the interest rate on this debt is like 4%. It's a range between 3.5% and 5%. It's really not too bad, and it's very well spaced out. And in the meantime, like the interest expense that they have to pay is like, it's very serviceable. And it makes sense for them probably to take on more debt, because they're using that debt to continue opening stores, which the ROI on the stores that they're opening still is really strong. Like I think I read this earlier this year, like they're seeing 50% returns on the new stores that they're opening. I think that's just here in the United States, but still that's a very, very impressive return. So with that said, if you're getting your money back on those new store openings so quickly, why not continue that expansion? If it's still generating those returns at least. So yeah, anyway, enough about that. Starbucks is just a very polarizing business. And then to throw in boycotts and Middle East stuff and union stuff, it's just kind of a lot going on with the company. But I personally think a lot of it's been more noise than actual substance. Probably some of you guys will probably disagree. And over a long period of time, you may be right and I may be wrong, but this is my interpretation of it all as I understand it. So anyway, sorry about the tangent, guys. Dividend Pro, Chevron has taken a dip. Do you think it's a good buy? I do. Yeah, it's kind of interesting. I think Chevron could be. I think it could be. One interesting thing I was looking at with Chevron, if we go over to Snowball Analytics, guys, they have this really cool tool here called the dip, or find the dip. I call it the dip finder or whatever. Same idea. And basically it will show the stocks compared to their 10-day moving average, 50-day, 100-day, 200-day moving average. And if we look at this, Chevron has been trending below, not much. It's been trending below their 200-day moving average. So it's not the end all be all, but that is one indicator that it could be maybe a bit more underpriced than usual. So, that is something to consider. And if you're going off this, or even if you're going more recently across the 100-day average, where it's even lower than it's even more discounted compared to the 100-day moving average by 6%. It could be a good time to add a little bit to Chevron. The current share price is $147.27. I know personally speaking, my average cost is about $100 per share. So I'm not in a rush to add Chevron right now, but I think you could probably buy it and be fine. So, and by the way, guys, Snowball Analytics, if you guys want to check this out, I've been so impressed with this portfolio tracker. The last couple of months that I've been using it, I still feel like I'm learning new tools and new bells and whistles with it. But excuse me, it's been a really fun platform to use, and it's been really great. So if you guys want to check this out, there's a link to it in the description of the video. You can try it out for 2 weeks free. I highly recommend it. This is between this and GetQuinn, I would say, outside of my portfolio tracking spreadsheet here, if you wanted something with more bells and whistles, I think those two are the best ones that I've used. And I found myself naturally gravitating more towards Snowball Analytics lately. But different people prefer different interfaces and stuff like that. And so, but yeah, I've been loving Snowball Analytics. So you guys check it out. Link in description, 2-week free trial. And if you guys use Snowball or have used Snowball, let me know too what you think. I'd be curious to hear what you think. So, so yeah, Chevron could be a good buy. Excuse me. Robert says, do you use margin to buy any of your dividend stocks, or do you try and stay away? No, my friend. No margin for me. I've never used margin. I never plan on doing so. I just think it's risky business. It's risky business. I think a lot can go wrong when you utilize margin. And on this topic, and also tying this back to YieldMax earlier, and we have let me Brooks, I'm sorry, I'm just now seeing this $2 super chat. Thank you so much. Let me finish this thought. We'll jump over to this next in a second. But where was I? I totally lost my train of thought. Okay, so what I've seen is a lot of people who invest in the YieldMax funds will take on margin to do so. I don't understand the math behind it. I'm speechless. I kind of can't believe that people do that. It just seems like so much can go wrong. It seems like so much can go wrong. And I pray for those people who do that. And I pray that it works out well for them. But I feel like that's I feel like you're playing with fire for sure. So no, to answer your question, no margin for me. It's not something I would ever do. I understand the temptation to do so, but I just think there's too much risk. There's too much can go wrong. And me personally, it would cause more stress than it's worth. So, but really good question. Thank you for asking. Brooks, going back to you. Sorry. I'm so sorry it took me so long to see this. And thank you so much for the super chat. But what monthly dividend stocks would you recommend? So I only own 2 monthly dividend stocks. I own Realty Income. I own Main Street Capital Corporation. I think they've both been great investments for me. I've been very happy with both of them. I will say this though, if I was you, I would not worry about whether a stock is monthly or not. I would not pay any attention to the payment frequency of the dividend. In the grand scheme of things, at the end of the day, whether you receive, let's say that you have a stock that pays $12 per share per year in dividends, okay? If it's a monthly paying stock, that's going to be $1 dividend per month. If it's a quarterly paying stock, it's going to be $3 per month. You know, at the end of the year, you're still receiving $12 in dividends. It all works out to be the same. And I don't think that you should use payment frequency in your evaluation of the quality of the investment, because that's really, the payment frequency doesn't tell you anything about the quality of an investment. Like Realty Income would still be Realty Income if it didn't pay a monthly dividend stock. It wouldn't make a difference. So I really would not worry about whether or not a stock is quarterly paying or monthly paying, because it really is all the same. And there are some people who will say, well, yeah, but like, you know, I want a budget. If I'm retired, I want a budget. I want that payment coming in every month because I want to use it. Well, once again, it's the same. I think if you're entering into that stage, you're probably still better off just learning how to budget 3 months at a time. But the thing is too, if you have a diversified portfolio, you're going to have dividends coming in every single month anyway. You know, you could own 3 different stocks and still be getting monthly dividends. And so that's another reason why I wouldn't worry so much about the payment frequency. You'll still, if you have a diversified portfolio, you'll get those dividends coming in every single month. And, you know, don't let the monthly payment status add any weight to, you know, give the investment any more points, because it really doesn't make a difference. So, but hopefully that answers your question. And I'll throw another good company that happens to pay monthly dividends in there. Agree Realty is another good one to look at, but not because it's a monthly payer, because it's been a solid REIT. So. Here we go. Phil, so first time joining the stream. Awesome. Welcome to the stream. And in case this is any of your guys' first time, to the Dividend Happy Hour. We do this every single week. So every Friday night, starting at 5 p.m. Pacific time, we'll be here. We'll be here talking stocks and hanging out. So yeah, I hope to see all of you guys. If this is your first time, I hope to see you back next week. This is yeah, this is a really fun thing. And I got to shout out my man, Chris. Chris, what's up, man? Long time no chat. I hope you're doing well. I see you've been playing, see you and your brother have been playing a lot of pickleball. That's awesome. So yeah, thanks for tuning in, man. Happy to see you in here. Okay, let's keep going. Dividend Dude. Hey, Ryan, I missed these streams. I could be wrong, but I feel like there hasn't been one in a while. My friend, we've been doing these live streams every week. We've been here. The last time that I did not stream was like the end of July. I went on my honeymoon, so there was 1 week where I didn't stream, but yeah, we've been pretty consistent with the streams here in August. But man, happy to see you in here tonight. Yeah, Matt here says, I've had many YouTube creators block me from trying to steer them away from YieldMax funds. Yeah, you know, people get really attached to those people get really attached to those funds. It's kind of like, I mean, I own SCHD, but it is kind of it is kind of SCHD. How do I say it? Like the cult-like following those have is there's some symmetry between YieldMax and SCHD in that sense. I do think YieldMax is way more cultish, and I do think they get a lot more defensive than SCHD, the SCHD crowd. But I don't know. I mean, if here's the thing though, if there is a logical, coherent, sensible strategy for investing in those, I'm all for it. I'm all ears. Like I will keep an open mind, but that's the thing. You never when you kind of push back on investing in those, you never get that. You never get a good reason as to why it's a good investment. Nothing that's outside of the dividend yield, at least, which I think the fact that happens is telling in itself. So, but I'm not trying to. I don't want to. I'm not trying to diss on YieldMax or anyone that invests in them, because you guys, you've got to do what you think is best in your portfolio. But yeah, I don't know. I just was going to say, I'm not trying to be a hater or trying to diss, because I do wish everyone well. I think the fact that you're investing it all and trying and making it, giving it an honest effort, I think is commendable. So I kind of just, I'll leave it at that. So. Let's see, Jorge, this is an interesting question. Do you think there will be a massive drop in the market when the baby boomers pull out of their retirement accounts? Man, I have no idea. I have no idea. I mean, there are a lot of baby boomers who are already retired. So no, I mean, I don't know. I don't know. I have no idea. I'm sorry that I know that was not like a good response to the question. It's just, that's way over my head. Oh, this is a good question. This is kind of fun. Tomas, I need to boost my income. Should I start a side hustle making money online? If yes, what? I study in university and sell cars at Mercedes-Benz. That's cool. Have a 5.6K portfolio and made 20 euros last month. That's great. So I don't know. As far as a side hustle making money online, I don't think it's a bad approach. I would think about maybe what your career is going to be. I know you're in school, so maybe you don't know yet and you sell cars, but let's say hypothetically, like, this is just one random idea. Okay. Let's just say that you're like, you know what? I'm just going to be a car salesman. I'm going to keep working at Mercedes. This is going to be my career. I'm going to really just go as far as I can with it. If that was the case, if I was you, I would start a YouTube channel or like an Instagram page or something talking about specifically about cars and specifically about Mercedes. And I would basically just start a channel or a page talking about those sort of things. And you can use that to funnel people to car salesmen, or somehow you can tie those things together. Who knows? Maybe you could even use that to start your own dealership someday or something along those lines. I'm getting way too ahead of myself, but that's one potential idea. I'm a huge proponent. I do this with my friends and my brothers too. I will try and push like YouTube channels on everyone I know. I'm a huge proponent for everyone starting a YouTube channel. It's just been for me, it's been such a huge blessing, and it's been something that's grown far beyond what I ever thought it could. And you just never know what can happen with these things if you just start it and keep going. So I'm always a huge proponent for doing something like this. And I think that the dividend investing is such a niche thing, right? Like it's such it really is a small community, and it's such a little corner of the internet that we occupy here. But still, like case in point, there is a community out there for whatever you're interested in. So if I was you, I would think about that too. Like, what are you interested in? What could you see yourself? Oh, hi, buddy. Hi, what are you doing? Come here. So anyway, if I was you, I would think about, come on. I would think about those sort of things, maybe what you're interested in, and try and start something around that. Once again, I'm a huge proponent for YouTube channels or doing something on social media. And I think that you can use that, if you're able to build a presence doing that, I think that can transfer into pretty much any other thing that you want to do. So outside of that, I'm not really sure. I don't really know much about I know there's channels who like specifically talk about side hustles, but I'm not really well versed in that stuff. So yeah, thanks, Matt. Use Ryan's affiliate Seeking Alpha promo code to get the dollars off the subscription. Yeah, you're able to save $25, I believe, on the subscription with the $25 on the subscription with the link in the description. So thank you, Matt. Appreciate it. Let's see. Yeah, I don't mean to keep going back to YieldMax, but this is a really good point that I didn't mention earlier. I do think, so at the end of the day, this applies to any fund, any ETF. It is an investment product. And no matter what the intent with these investment products, whether it's SCHD or whether it's YieldMax, whatever it is, the intent is to, generate revenue for the businesses that create these funds. It's to line the pockets of those companies. And there's, if that product is providing value to the person who consumes it, then great. Like that's fantastic. That's a fair trade. And I think you get that with, like, you certainly get that with VU. You're going to get that with VTI. You're going to get that with, the SCHD, the funds that actually deliver solid performance, and also don't charge you an arm and a leg for it. SCHD's expense ratio is 0.06. Others are even lower. Some of the Vanguard ones, I think, are 0.03. Correct me if I'm wrong. Maybe it's SPY. I don't know. Some others are 0.03 compared, and those actually make you money compared to YieldMax, where you lose money and you have to pay a 1% expense ratio on top of that. So you're paying a lot more to make a lot less. And I just think that more than anything, it builds wealth for the companies that create them instead of the people who own the actual funds. So. Okay. And that's enough of the YieldMax stuff. The horse is dead, and we just keep beating it. Let's see. HRB, can you check it out? Yeah, let's check out HRB. Actually, and I'll go back to, someone mentioned, Shannon mentioned AGM. So I'll take a look at that too. But yeah, let's take a look at HRB real quick. So this will be fun. Let's go over to Snapstock. Check it out. Oh, H&R Block. Nice. So it's done really well this year. Wow. Up 68% in the last year. Year to date, it's up almost 40%. Wow. Nice free cash flow yield, 7.5%, which is, I guess, is a bit lower than the 5-year average, but according to this, 2% yield, low payout ratios, dividend growth rates. Okay. And just for confirmation, I want to compare these stats to, okay, so it's pretty similar. I want to compare the stats to what Seeking Alpha shows just to make sure we're not too off the mark. And there's going to be, I'm sure you guys have noticed this, whether you use Seeking Alpha, Yahoo Finance, Google Finance, soon Snapstock, hopefully, whatever platform you use for stock analysis, Tip Ranks, Guru Focus, whatever it is, there's going to be some discrepancy between platforms, but I'm looking to see, is it in line? Is it at least similar? And yes. Okay. So I will say, the share price appreciation over the years has been fantastic, really, really good. So really solid appreciation, but I will say the dividend stats are a bit weak. With a yield like that, I personally would want to see a dividend growth rate that's, higher. Like I'd love to see some more classic dividend growth metrics. Excuse me. And with that, because the share price has appreciated so much and the dividend growth has been lackluster, the yield is going down over time. And we'll see that if we continue to scroll down here. We'll come back up to some of the growth and profitability metrics, but and that stuff too. But yeah, we can really see just with the appreciation, the dividend yield has gone way down. So back in, obviously 2020 we'll give it a pass, but the 5-year average yield is 4%. The 10-year average yield is 4%. I would take a 4% yield with a 4% dividend growth rate. I think that's a bit more, that trade-off is a bit more fair as opposed to a 2% dividend yield with a 4% growth rate. So if you're gonna have a low growth rate, me personally speaking, if there's gonna be a low growth rate, I want to see a higher yield. I want to see that trade-off, and vice versa. If it's gonna be a high yield, then I'm okay with a lower dividend growth rate. With that though, the dividend growth has been consistent, as we can see. I mean, according to the chart above, or the stats above, they have 8 years of dividend growth. The dividend growth has been really spotty throughout the years. I mean, there was a couple years where it was close to double digits, 8.5%, 9%. 2022 was 6%. So the dividend growth has been all over the place. Payout ratio is very low. Looks like they had negative earnings in 2020. Free cash flow payout ratios been looking good. They're buying back shares like it's nobody's business, right? So that's really good. Wow, yeah. So on average, they've bought back 7% of their shares over the last 10 years. Let's look at that. On average, over the last 10 years, they're buying back 6% of their shares every year. So that's great. Really good. Solid returns on really solid returns on invested capital. Really solid. So it's not, based on some of these, it's not so surprising to see the share price up as much as it is. But with that, the revenue growth hasn't been that fantastic, not that aggressive. The earnings growth, this number is getting skewed by 2020 for sure, but the earnings per share looks like it's done pretty well. That's a nice looking chart. We're going to give them a pass for 2020. Free cash flow per share has been looking really good as well. So I do think there is there is some stuff to like about the financials. It looks like the gross margins are improving over time. The net income margin right now in the trailing 12 months, and actually over the last few years since 2021, it's considerably above this 5-year average. So that's good to see. Looks like the same is true with the free cash flow margin. So I do think this is looking, there's some good stuff in here. There's some good stuff in here. H&R Block is taxes, right? Tax return prep. Yeah. Okay. So it's kind of like maybe similar to an Intuit perhaps. But H&R Block has actual physical locations where I think you can go and have someone do your taxes there, right? So yeah, I think it looks interesting. But anyway, Shannon asked about AGM. So let's take a look at that. Oh, I looked at this. This is Farmer Mac, right? I looked at this one. Yeah, this is Farmer Mac. I looked at this one last week, and it was I didn't. This is over my head. This company's a bit over my head. I couldn't really figure out how to uh, look at its financials, but there's some good stuff. I mean, if just looking at the charts here, really solid revenue and earnings growth, and free cash flow growth as well. Crazy high margins, right? I mean, yeah, really, really high margins. The debt they're taking on debt, and this is where we'll need to jump over to Seeking Alpha. So AGM, what is most of their debt? If we just look at their balance sheet, at some point I would like to show the financial statements on Snapstock, but one thing at a time. Okay. Total liabilities. See, this is where I'm getting kind of tripped up, because it says they have 28 billion of total liabilities, but I'm just not seeing how it adds up to that. Current portion of long-term debt. I mean, I guess it's mostly just like long-term debt, right? And whatever other short-term borrowings, but we're just not. I'd have to look at the 10Q, and I guess I could, but so I don't know. I would really, Shannon, I'd really have to spend more time with this company to understand what's going on, but it looks like the growth metrics are very strong. I'm starting to get sweaty, starting to glisten a little bit, guys. It's getting toasty in here. We didn't look at the dividend stats, so let's do that. So really solid dividend stats. The yield is going to be quite a bit below the 5-year average right now, but they've had a really solid run up in share price. Like they're up almost 200% in the last 5 years. So, yeah, and the dividend growth it's slowed over the years, but still it's really, really good. Still double digits with the exception of last year, but yeah. Payout ratio has kind of been on the up and up over the last decade, but it's still not bad. Yeah, it's okay. Yeah. Seems like an interesting company for sure. Yeah. Any thoughts on Pfizer? And guys, just a quick sidebar. I'm like 30 minutes behind in the chat. After this, we'll take a look at Pfizer. After this, I'm going to catch up, really catch up. In fact, let me do this right now. But anyway, I was going to say, what was I going to say? I was going to say it's like the top of the hour, and usually we would kind of wrap things up now. We'll go for another few minutes. We'll go for another few minutes, another handful of minutes. So let's see. Not quite ready to wrap it up here, but okay, I'm scrolling down. We'll go look at Pfizer in just a minute. I just want to get caught up here. In the chat. What's up, Russ? I don't know if you're still in the stream, but what's up, man? Just saw you in the live chat. Let's see. Okay, and I apologize if I skip over some of your guys' comments real quick. We'll go back to Pfizer. This is a quick question. When am I going to do a new subscriber portfolio video? So I'm actually not going to do my next one until next month. Normally I would have one come out actually this Sunday. Like that would normally be the next one. But I'm actually switching gears for this month. And instead of reviewing subscriber portfolios, I'm actually going to be reviewing my own portfolio and doing a deep dive on my own portfolio. That's something that I try and do every year. I did the video last year. It was a really fun one. And it's also good for me too, to just kind of, go into my own portfolio and try and give myself some like honest and hopefully objective feedback. So that's going to take the place of the portfolio review videos this month. And that's going to be coming out Sunday. So, okay. And I see a book question. So we'll come back to that. I want to go look at Pfizer real quick. So historically, Pfizer's been a pretty solid cash flowing investment, and a good dividend stock to own. But since the pandemic, or since, I guess, post-pandemic, excuse me, it's really been a tough one. It's really been a falling knife. And over the last 5 years, the performance is pretty lackluster. It's up 8% over the last 5 years. So pandemic, 2020, it really skyrocketed, which is no surprise. They had all the vaccine sales. But then once things calmed down with that, those vaccine sales really fell off a cliff. And subsequently, the share price did as well. And if we scroll down looking at their revenue, we're seeing that here as well. So we can see 2021, 2022, it really jumped up and then it's come back down. And so this is mostly just from the loss of vaccine sales. So that really had a big impact on the financials. And we can see that reflected in the earnings per share and the free cash flow per share as well. So yeah, that's all kind of returning to homeostasis. And I think it's still kind of in that stage where it's still trying to find the bottom. Because now it looks like, at least for 2023, and the same is true with the earnings, it looks like both of these are below where they were at before the pandemic. So, I personally would wait. I'm personally in no rush to add to Pfizer. I think Pfizer's kind of a wait and see what happens at this point. The share price looks like it's kind of started to turn around. It's still down year to date. And I wish we had like a 3-month chart or a 6-month chart, but since April, it has come up a little bit. Looks like it's come up maybe about 10% since April. So it is kind of making its way up. And this isn't great as well. So net debt really jumped up in 2023 to 72 billion. Furthermore, the net debt to free cash flow is now at 15, where prior to this, they, unless this is a glitch for some reason, prior to that, the debt situation was fine, but I think that's a bit concerning. And furthermore, the interest coverage is pretty weak as well. So I'm a bit concerned. If these numbers are right, I'm a bit concerned with that. And that would definitely like steer me away from wanting to invest in this company. Now, with that said, the dividend yield, not surprisingly, because the share price has come down so much, the dividend yield is way above the 5-year average. So the 5-year average is 4.4%. In the trailing 12 months, the yield is, near 6%. So you're getting a nicer cash flow return to compensate for maybe some of the other poorer metrics that we're seeing in the financials. And excuse me, we can see too, the dividend growth has just really dropped off. It's still growing. The dividend is still growing, but it's really dropped off. The payout ratios aren't great. Looks like they have negative earnings, negative net income in the last 12 months. 2023, crazy high earnings payout ratio, free cash flow payout ratio. This isn't great. And if this persists, it would not surprise me to see Pfizer cut their dividend. If all of these stats are right and all of these trends are right, it would not surprise me to see Pfizer cut their dividend. And even so, and these two right here are skewing this, but an 80% free cash flow payout ratio, 5-year earnings payout ratio of 134%. And it's not. I mean, 2020, the payout ratio was very high as well. Otherwise, though, aside from 2020, 2023, in the trailing 12 months, the payout ratio has been, well, actually not. I'm actually wrong. More often than not, it looks like it's been high. Is that right? Let's cross-reference this with Seeking Alpha. So yeah, I guess so. Not great, guys. Not great. No bueno. So yeah, Pfizer would be a no for me. Okay. There was this comment about the books. Here we go. Mustafa. Hey, Ryan, hope you're good. Oh, man, I'm doing great. Do you have any recommendations for books that help in understanding psychology in investing? Or how did you get to learn more about psychology throughout your investing journey? So I would read Morgan Housel. I think that'd be a really great place to start. I would read The Psychology of Money, and I would read Same as Ever, which is his new book. And also, you know what, Mustafa, and for the rest of you guys out there, if you're looking for some good book recommendations, if you go over to my website, go to retirewithryan.com, go to resources up here. And if you click books, it will take you to a page where I have all my book recommendations. So for psychology, the ones that I would recommend, Same as Ever by Morgan Housel. I would recommend The Psychology of Money, also by Morgan Housel. I would recommend Poor Charlie's Almanac. I think you'll learn a lot from that as well. And I would definitely recommend Thinking Fast and Slow by Daniel Kahneman. This one's a bit heavy. Not heavy is not the right word. It's one that you'll have to read slowly. At least that was the case for me. But you'll learn about a lot of good psychology from reading those few things. I also think you can pick some stuff up from reading this book right here, The Great Depression by Benjamin Roth. But truth be told, that really wasn't one of my favorites. And actually, on the topic of books, guys, let me show you. I just got 2 more books. I just got 2 more books in the mail today. So I've already shared these ones with you guys. The Almanac of Naval Ravikant, which I think maybe is going to be next on deck for me. And then I have Fooled by Randomness by Nassim Taleb. There we go. And then I just got these 2 in the mail today. Investing, I think Russ read this book or listened to it. Investing, The Last Liberal Art by Robert Hagstrom. I think there's going to be some good psychology stuff in here. In fact, there are multiple chapters dedicated to one chapter to psychology. There's a few: sociology, psychology, philosophy, decision making. So this would probably be a good one as well. I haven't read it yet, so I don't know if it is good, but this is supposed to be an investing classic. Then I also just got this book today as well, Thinking in Bets by Annie Duke. Lot of psychology in this book as well. So and this is a classic as well. Annie Duke was a professional poker player. Here it is. So in a book that's become a classic, former World Series of Poker champion Annie Duke draws on examples from business, sports, politics, and of course poker to share tools anyone can use to embrace uncertainty and make better decisions. So yeah, I think this sounds like it might be up your alley. Let's see. Okay. I want to catch up here. Yeah, there we go. Peanut appeared. Jana, cool watch you're wearing tonight. Thank you so much. This is the newest one in my collection. This was kind of a little birthday present to myself. My birthday was last month, and this is also like my honeymoon watch. I was trying to find any like rationale I could to justify buying it. This is a watch that I've been wanting for a while. It's a dive watch. This is the Seiko SNE 573. You can see just classic black, 39 millimeter case. I think it's 12 millimeter thick. And I have it on just this NATO strap that I bought from Amazon. But this has been such a fun watch. I've been loving wearing this. And I've been wanting a dive watch for a while. And I was between a few of them. The ones that I was, a few of them in a few different price ranges. I was looking at like a Tudor Black Bay, which is probably $4,000. I was looking at a watch brand called Squale, which is a classic, very like historically important watch brand that specializes in dive watches. I think the one I was looking at was maybe $1,400 there, or this. And this was, I think this was less than $400. So yeah, I was like, this is a no-brainer. This is going to be just fine. I love my Seikos. This is my 3rd Seiko watch, and it scratched the itch for me that I'd had for a while. So like after this, I'm good on watches for a while. I honestly don't know what other watch I need besides the ones that I currently have. I'm sure I'll find some others that I'm interested in, but for now it's good. So okay. Let me just get caught up in the chat and see where we're at, and we might wrap it up from there. Russ, what the heck is Snap stock? Well, I kind of just you probably saw it. Text me if you didn't see me going through it. I'll give you the rundown. It's something I've been working on. Yeah, something I've been working on. Okay, I'm sorry, guys. I'm just getting caught up here. Stonked up. Love you, buddy. Your emails are great. Thank you, my friend. I really appreciate that. Really appreciate that. Thank you so much. Hagan, good to see you, man. Hopefully I pronounced your name right. And I know I owe you an email back. I apologize. I haven't gotten back to you yet. Let's see. Ooh, good question. When Ryan and Russ show? I don't know. Hopefully soon. It's been a while since Russ and I have caught up. So I don't know. We'll text about it. We'll text about it. That'd be fun though. Okay. Yeah. Yep. I see the shots about Peanut, shots about bringing out the books. You guys know the rules, the drinking game rules. I didn't shout them out. I wasn't good about doing that, but I should have been. So soon you'll have 20 watches. No way. I have 5 right now, and I think that's probably already too many. I think I can probably trim my watch collection a little bit, but a couple of them are sentimental value, and I kind of swap watch. I kind of go through phases where I'll wear watches for a period and then I swap them out with another one. So I usually have like 1 or 2 in rotation at any given time. Right now for me, it's this one and my my gold Bulova, the Chevron watch. I think I've shown you guys that before. I've been wearing those pretty consistently. I have another Seiko that's kind of like looks kind of like, it's like basically a Seiko Datejust, and I go through phases where I don't stop wearing that as well. So next up, Richard Mille. No, I don't, or Richard Mille. I really don't like those. I really do not. I am very classic. If I was to get another watch, so let me see what's Omega. Sorry, guys. I won't spend too much time on the watches. Let me show you. There's one that I'm square green. There's one that I'm really like, I think it's just such a cool look. And it's going to be one that's hard to find, but it's something like this. So Omega used to make these TV dials, what they call it, that square dial. They used to make the constellations. They used to make, I believe, Seamasters in this shape as well. And I just think that's such a cool look. Yeah, right, like right here, you know, or right here, that green is a little bit better. But this is one that something that I really want. I love the green dial. That is such a unique watch to me. So this one would be, and you can get them for like a couple grand, well, a few grand, I guess, looking at this, but something like this, I would love to have someday. Black Bay 54. I also really like the Tudor Black Bay 54s. These have been kind of like the hot trendy watches in the watch community. So I think these are really cool. But you know what? There's a Imperial. There's a few micro brands that I've been following, and micro brands are like under the radar watch brands. There's this one right here called Imperial Watch Company that I just think has a really cool Pepsi GMT. And a GMT is a watch that shows you basically 2 different time zones. But this one right here, it's sold out. But I'd love to have a Pepsi like this. I think that's so cool. And there's another company, Laurier. Oh, Lori. And I'm sorry, guys. I know most of you don't care about watches. And I'll wrap it up after this. But this is another one that I was considering as well. This one is very similar to that Tudor Black Bay 54. If we can maybe pull this up, you'll see that they're very, very similar. And this is actually the new Black Bay that came out. colorway, but I almost like this Laurier better. And this is a micro brand. It's a husband and wife team that owns the company and makes the watches. I just think this is such a classic, timeless look. And when it comes to watches, that's really kind of what I go for. Like the watch I'm wearing now, it's going to be, I don't want to say in style, but it's still going to look good and it's still going to be fashionable, 50 years down the road. And that's really, I mean, the same is true with this t-shirt. And that's just kind of my thing. That's kind of how I try and approach these things. So, oh, Hagen. Okay, cool. Yeah, sorry about that. Hagen, cool. That's good to know. Maybe. I love the Grand Seikos. Thoughts on Palantir? Truth be told, Patrick, I don't have any thoughts on Palantir. I've never looked at Palantir. I think Matt, correct me if I'm wrong, but I think you've spent some time with Palantir. Correct. I might be wrong on that. I don't know, but I'm not the best person to ask about Palantir. I know nothing about the company at all. So, Brian, do you ever smoke cigars on special occasions? I mean, I'm open to it. I really think they're cool. I think they're fun. When we first moved to Vegas, this is the last time I had a cigar. When we first moved to Vegas, my wife, and she'll do this from time to time, different conventions come to town and you can get jobs like working those conventions. And so she was able to work the cigar convention that was here in Vegas. It's an annual thing, big cigar convention. So she was able to work that. And she brought me home like a couple cigars from that they'd given her. And so, yeah, I'd smoked those and that was fun, but I don't actively buy cigars and I don't actively smoke them, but I like to. I think it's cool. It's fun doing that. Yeah. So, yeah, Michael said, since cell phone gives you the time, I never wear a watch. I totally get that. I totally get that. And I think for me, I like wearing a watch, number one, just because it's a cool accessory. And also number two, I really don't like having, I really don't like being plugged in all the time. I really don't like always having my phone on me or, whatever. And so I've been wearing, this has been my gym watch. I've worn this pretty much every day to the gym since I've got it. And it's actually, I've kind of switched up my training style. So what I'll do, so it's got the, I don't know if you can hear this. Can you hear that click? It's got the bezel. Oh yeah, that's juicy. It's got the bezel that you can wind. And so what I'll do is I'll use this to set a timer on my phone, go to the gym, set a timer on my phone for 10 minutes. And whatever exercise I'm doing, whether it's bench press or pull-ups or dips or squat, I'll basically just set a timer for 10 minutes, choose a weight that I can do comfortably for, 8 to 10 reps. And I'll do as many sets as I can within that 10-minute time frame. And it's been a really intense way to train, but it's been fun. And it's also helped me get in and out of the gym a lot quicker. And I'm also more focused. And yeah, I could set a timer on my phone as well, but I would check my phone. And with this on, I don't. I just look at my watch between sets, time it. When I'm done with my set, time it 30, 40 seconds, hit the next set. And so it's been practical in that regard as well. But also, like I said, it's a fun accessory. And also someday down the road, this is the last thing I'll say. Someday down the road, like, these watches, kind of like my dividend portfolio, these watches will outlive me. Like I will be able to pass my watch collection down to my kids or my grandkids when the time comes. And then hopefully it'll be a special sentimental thing. And, you can't do that with an Apple Watch. It's not going to have the same impact. So, yeah, it's special to me in that way as well. So, and also, I look at this watch and I think of a certain time in my life. I look at this watch and this is what I wore on my honeymoon. And when I look at it, I'm, taken back to that time. And I can I look at the watch and I can taste the mezcal margaritas. So yeah. Wow, guys, we're at almost half an hour past. Okay. Okay, I'm almost caught up in the chat here, so Yeah. Did you say your wife has Target? Yeah, she has Target. She has Starbucks. She has VTI. She has Coca-Cola. She has Dutch Bros. I think she has Lululemon as well. Someday it'd be fun to do a little portfolio review for sure. Yeah. Ultra runner, time to join me for a run. You know what's funny? I've actually been thinking about getting back into running. I've kind of had the itch to do that. I've had the itch to do that lately. And running's starting to become a very trendy. It's becoming a very popular thing. The big thing that you're seeing right now is run clubs. You're seeing a lot of running clubs popping up. I follow a few of them just here in Vegas. They meet up every week. I think it's a really cool thing. I've thought about going out to one of them, but I just don't have like good running gear. I need to get new running shoes. I need to probably get like, something to hold my water or my keys and stuff as I'm running. So I need to figure that out. But yeah, I'd like to start getting back into it. And that kind of goes just with not being plugged in all the time. Obviously, if you're running, like you're focused on that. It's not like you're going to be checking your phone like mid jog. And so it's kind of a nice way to tune out, and yeah, it's kind of a nice thing. So running's always been very therapeutic. And back during the pandemic when all the gyms were closed, I was a running machine. But then after that, I kind of fell off, but it was fun. Jack said he got his first Orient Bambino. Yeah, Orient's a really nice brand. I don't know the Bambino, but let's check it out. Orient Bambino. He said it goes with a lot. Yeah, I could see this. This is nice. This is a nice looking like kind of dress watch. Actually, it might even this might be a field watch. Actually, considered a field watch. But this is pretty. Yeah, Orient's a nice brand. Very timeless brand, or very historical brand as well. I think, are they Japanese? I think Orient's Japanese. Them and Seiko, I believe. I thought they were Japanese. Where does it say? Maybe I'm wrong. Oh, no. Yeah, it's Japanese. Okay. So any of you guys who are into watches, check out the Urban Gentry YouTube channel. Urban, Gentry. I've been binging that guy's videos. Absolutely love that channel. It's one of my favorites. But it's a really good watch channel. So hopefully Christopher Walken won't have to kiss it before your kid gets the watch. That's my Christopher Walken. All right, guys, we're pretty much caught up here. We're caught up in the stream. It's 6:30. Time flies when you're having fun, guys. Time flies. Should have been checking my watch. But man, thank you guys so much for hanging out with me this last hour and a half. I really didn't realize how much time had passed. So yeah, this was fun. This was a really fun stream. So take one more sip. All right, guys, we're going to call it a night. But before we do, a couple things. If you enjoyed this stream, don't forget to hit the thumbs up button for me just one time, just real quick. There's 150 of us here in the stream. I'd love to end this and see 150 likes on the video. If not, it's okay, but just one small little thing. So definitely hit the thumbs up button. And also, guys, be sure to tune into Sunday's video. I mentioned it earlier, but in Sunday's video, I'm going to be doing a deep dive into my dividend stock portfolio. I'm going to it's kind of like a state of the union of the portfolio in a sense. And I'm going to be going through the portfolio and sharing what I think are some of the good aspects of it, as well as the things that I think could be improved about this portfolio. And I did this same type of video sometime last year, maybe around April or May last year. And I will say, just kind of reflecting on the changes between then and now, this portfolio has come a long way. And I'm so happy to see it. And I'm so happy to share with you guys that video and just show you what all has been going down. But yeah, definitely check out that video on Sunday. And I think that's about all I got for you guys. But yeah, thank you so much again for your time and for hanging out with me and for just being so engaging in the chat as well. It looks like, yeah, so engaging in the chat. I hope you guys all have a good weekend, and proud of you guys for doing your thing and just being the good dividend investors that you are, and continuing to take steps towards financial freedom. Keep it up. That's what it's all about. And yeah, I second this here, Jim. 90 minutes, Russ. Pressure's on, man. But yeah, anyway, I hope you guys have a fantastic night, an awesome and safe weekend. And I'll see you guys in the next one. Take care.